You may have seen headlines saying the IRS is using AI to audit more people in 2026. Some videos make it sound like the IRS is watching your lifestyle or scanning your social media. The reality is less dramatic, but far more important to understand. In 2026, audits are increasingly driven by automated systems that compare your tax return to massive amounts of data. Not to spy on you, but to spot patterns that do not make sense. If you are a small business owner, freelancer, or real estate investor, understanding how these systems work can help you avoid unnecessary attention and file with confidence. Over the last few years, the IRS has been modernizing its enforcement systems. Much of the conversation started when Congress approved major funding to improve collections, technology, and audit efficiency. What often gets missed in the headlines is that the IRS is not trying to audit everyone. Their stated goal is to close the tax gap, especially income that is reported inconsistently or not at all. To do that at scale, the IRS relies more on automated analysis and less on random selection. That shift is already happening, and 2026 is where many of these systems are fully integrated. Now, when people say AI audit, they are usually referring to automated systems that use statistical modeling and machine learning. These systems do not decide guilt. What they do is flag returns that fall outside expected ranges. Your income, deductions, and ratios are compared to similar taxpayers in the same industry and income bracket. If something looks unusually high or unusually low, that return may be selected for further review by an actual human examiner. Okay, flag number one. This is one of the most common red flags, reporting income that looks unusually low compared to similar businesses. For example, if most consultants in your field report a 30% profit margin and your return shows near zero profit year after year, that stands out, especially if your gross receipts are substantial. This does not mean you cannot have a bad year. It means repeated patterns without clear explanations attract attention. Clean books and consistent reporting matter more than ever. Number two, 1099K and income mismatches. This is one area getting a lot of attention right now. Payment platforms like PayPal, Stripe, Venmo business accounts, Etsy, and others are reporting more data to the IRS. If the IRS receives a 1099K showing $10,000 of gross payments, but your tax return shows significantly less income or no income at all, that mismatch is easy for automated systems to spot. This does not mean you are taxed on the gross amount. It means your return must clearly reflect that income and properly deduct expenses. Ignoring the form is one of the fastest ways to trigger a notice. A question I get a lot is, what if a platform should have issued a 1099K but didn't? The key thing to remember is that the 1099K does not create the income. The income already exists. Even if you never receive a form, you are still required to report the income based on your records. The safest approach is to download your transaction history, report the gross income, deduct expenses properly, and move on. I actually have a full video breaking down the 1099K rules because they've changed several times and caused a lot of confusion over the past few years. I'll link it below and add a card above if you want a deeper dive. Red flag number three, lifestyle and reported income. This red flag gets talked about a lot online, and it's often misunderstood. The IRS is not scrolling through your Instagram or watching how you live day to day. What does matter is whether the numbers on your tax return make sense together. For example, if a business reports very low income or repeated losses, but also claims large deductions for vehicles, travel, or other high cost items, that combination can stand out. Not because any one item is wrong, but because the overall picture looks inconsistent. Automated systems are designed to ask one basic question: do these numbers logically fit together? When income, expenses, and deductions tell conflicting stories, that's when a return may get flagged for review. Red flag number four, vehicle deductions. Vehicle deductions have always been an audit hotspot, and they continue to get extra attention as enforcement becomes more data-driven. Large first-year deductions under Section 179 or bonus depreciation are easy for automated systems to identify, especially when paired with claims of 100% business use. Claiming 100% business use on a vehicle is absolutely allowed under the tax law, but it just requires strong support because it easily becomes a statistical outlier. Again, outliers are not wrong, they are just easier to flag. Another thing systems look at is scale. If the vehicle deduction is very large relative to the income of the business, that imbalance can raise questions. This is why mileage logs, business purpose documentation, and consistent treatment year to year are so important. I also have a full video breaking down the new Section 179 and bonus depreciation rules, so check it out, which I'll link below and add above. Red flag number 5, short-term rental losses. Short-term rentals also continue to be an area of focus because the rules are complex and often misunderstood. Many taxpayers have heard that short-term rental losses can offset other income, but fewer understand the strict requirements behind that strategy. When a return shows large rental losses reducing W-2 or business income, automated systems can flag that pattern for review, especially if those losses appear year after year. The key issue is not whether short-term rental losses are allowed. It's whether the taxpayer meets the material participation and other qualifying tests, and whether that activity is properly documented. Red flag number 6, expense ratios. This is where AI-style pattern analysis really shines. Automated systems are very good at comparing expense ratios across similar businesses. If your meals, travel, vehicle, or home office expenses are significantly higher than what is typical in your industry, that difference can stand out. The same is true when expenses grow rapidly while revenue stays flat or declines. None of this means you cannot deduct legitimate expenses. It means your deductions should be reasonable, consistent, and supported by the nature of your business. Red flag number 7, home office deductions. While completely legal, it is one of the most frequently questioned deductions because it relies heavily on judgment and documentation. Automated IRS systems look at things like the size of your home office compared to your total home, the size of the deduction compared to your business income, and whether the deduction appears consistently year over year. When those ratios look unusual, the return may be flagged for follow-up. If the IRS does question a home office deduction, here's what typically happens. First, the return is usually selected for a correspondence review rather than a full in-person audit. The IRS will send a letter asking you to substantiate the deduction. That request often includes things like your square footage calculation, a description of the space, and copies of expenses such as rent, mortgage interest, utilities, insurance, or property taxes. The key issue almost always comes down to exclusive and regular use. This is where many people run into trouble. If the space is also used as a guest room, a family room, or a shared area, even occasionally, the deduction may not qualify. If the IRS is not satisfied with the explanation or documentation, they may reduce or disallow the home office deduction. That can result in additional tax, interest, and sometimes penalties. In some cases, once one deduction is questioned, other areas of the return may receive closer review as well. Finally, red flag number 8 is hobby versus business. This one catches a lot of people off guard. But before we go further, it's important to define what the IRS means by a business versus a hobby. A business is an activity that is carried on with a genuine intent to make a profit. A hobby is an activity that may generate income, but is not operated primarily to earn a profit. The IRS does not base this decision on a single factor. Instead, they look at the overall facts and circumstances. The key question is not whether the business is profitable yet, but whether it is being run in a way that is intended to become profitable. Now, automated systems can flag patterns where income is consistently wiped out by losses without signs of improvement. The IRS looks for evidence that you are trying to make a profit. That includes keeping proper records, adjusting pricing, marketing your services, and operating in a business-like manner. Enjoying what you do is not a problem. But if the activity never turns a profit and shows no effort to do so, that pattern can raise questions. Let's wrap this up. In 2026, IRS audits are less about random selection and more about how your tax return compares to expected patterns. Automated systems help identify inconsistencies, but they don't replace human judgment. Most audit issues are not caused by taking legal deductions. They happen when income, expenses, and deductions don't tell a clear or consistent story. That's especially true for vehicles, rentals, home offices, and businesses that report repeated losses. If you focus on clean reporting, reasonable ratios, and solid documentation, you dramatically reduce your risk. That approach matters far more than trying to avoid deductions or outsmart the system. If this video was helpful, subscribe for more updates on IRS changes and small business tax planning. And check out the related videos linked below for deeper dives into topics like 1099K rules and vehicle deductions. Thank you for watching.